we are going to bring in Dean Orrico, manager of Middlefield Canadian Income. Dean, are you there?
Yeah. How are you, Matthew?
Very well. Thanks for joining us. So for those who don't know, Dean is president and CEO of Middlefield Group, and he's lead manager of Middlefield's real estate and London Stock Exchange listed funds, which includes Middlefield Canadian Income, which we are going to discuss today. Dean, do you just want to give us sort of a few minutes, just talk through the fund, tell us what you do? Yeah, just give us the sort of big elevator pitch, if you like.
Sure. Thank you for having me. And at a high level, we launched this fund in 2006 on the London Stock Exchange, and it's really just a continuation of what we do here in Canada. We're headquartered in Toronto. We've had a London office and have been managing money for UK-based investors really since the early 1990s. Given our expertise in equity income, we wanted to bring that expertise and our strategy to UK investors, and that's what we did in 2006 when we launched this fund. And as you'll see through the slides that you'll be on the screen in a few minutes, this is really quite a unique strategy. We are in the peer group of North American funds, investment trusts, but we are uniquely Canadian. They call themselves North American, but by and large, they are all really focused on the U.S. market. Mm-hmm. And we really believe that there is a very unique value proposition right now in Canada, which is represented in our fund.
Excellent. Okay, do you want to run through some of the slides then?
I'd be happy to, yeah. So starting at the macro level, Matthew, I think, again, this is really creating quite an attractive backdrop for Middlefield Canadian. When you look back through the last 20 years or so, this period of 2010 to 2021 was really one that was highlighted by zero interest rates coming out of the GFC, mm-hmm. and that really made anything very growth-oriented and hence technology-focused the highlight of the market. And that's not what we do at Middlefield. We're generally looking at relatively dull, boring businesses that generate high levels of cash flow and pay out high levels of income. And we think what was basically a headwind during that 10-year period changed in 2021 as you started to see higher levels of inflation and central bankers basically respond with higher interest rates. And we've seen, as you have been discussing, much higher interest rates in the last 18 months than we had for the 10-year period prior. And we think that's really creating an environment right now where you just can't rely on growth stocks because they're long duration assets now being discounted at a higher interest rate. We think rates and inflation will remain higher than what you've seen during that prior 10-year period. Maybe not as high as they are today, but we think the days of zero interest rates and relatively non-existent inflation are in the rearview mirror. So as a result, we think from a macro perspective, that's really setting us up for a much more attractive environment for what we do at Middlefield and what we're invested in Middlefield Canadian. And it's somewhat analogous to this super cycle in commodities that we saw during that period of kind of 2000 to 2010, when China came into the WTO. It basically had this insatiable appetite for commodities, a lot of the things that we produce here in Canada. And I think what's also reminiscent of that period is Russia's invasion of Ukraine on February 24th of last year, which again is highlighting that there is a real necessity and demand for secure sources of energy, basically helping us transition to a more environmentally friendly energy environment, but highlighting the need for security. So really that's where we are today. And as you can see at the bottom of this particular slide, we are also now seeing very attractive valuations in the Canadian market, because even if you exclude the technology sector, Canada's still trading at a 3-turn discount to the S&P 500. So again, with this macro environment being much more conducive and valuations being very attractive, we think this is turning out to be a very good setup.
That
The next
chart
slide.
is sort of particularly interesting. Why do you think that Canada is sort of trading at a bit of a discount there?
Well, I think there's a few reasons. One, even this year, Matthew, it's really been an environment highlighted by technology. Really, when you look at what's happened with the S&P 500 up 17 or 18%, the Canadian market's only up 5%. And I think there continues to be concern about hydrocarbon energy. There continues to be concern about financials. Again, about a third of our market in Canada is financials. We arguably have one of the strongest financials or banking sectors in the world. But we also know that in this era of higher interest rates, there's concerns about mortgage repayments. Capital markets activity has been basically non-existent. Wealth management industry continues to suffer under higher levels of compliance and thinner margins. So again, our financials haven't really led the way like they have in previous eras. So I think all of these things are conspiring to make the Canadian market more challenged and hence undervalued, especially when you compare it to the US market.
Yeah. Okay. You have a look at the next slide? Or...
Sure, that'd be great.
Okay.
So again, given this view that we think inflation is going to remain higher than what you've seen historically, again, not the 8 or 9% range, but clearly not the 0 to 1% range that we had for an extended period prior to 2021. We think Canada represents a great way to hedge yourself against these higher levels of inflation. We describe this on this particular slide. We are a net exporter of oil, natural gas, and electricity. Again, that provides this better positioning relative to higher commodity prices. And when you just look at our petrol costs versus petrol costs in the UK, we're some 35% less than what you see in the UK. Significant lower cost of electricity in Canada, again, what you'd see in the UK. So Canada does have some real relative advantages relative to the UK and or Europe. We're also a major producer of key materials, potash, one of the major sources of fertilizer. Again, we're the largest producer globally. And I would also say that with respect to inflation generally, we continue to have relatively lower levels of inflation, again, by virtue of having an abundance of resources, which we're not having to import and pay higher prices for. I think that's keeping inflation down. The other factor is that on a population of 40 million people, last year we brought in about 500,000 permanent residents and another 500,000 people in the form of temporary foreign workers and international students, because we have some world-class universities here in Canada. So I think that addition to our labor force is also helping to keep labor costs more in check, and as a result, again, keeping inflation down as well.
Okay, that makes a lot of sense. All right.
Want to move to the next slide?
Yep.
So let's look at the fund in particular. Again, in our view, this is unique, and as a result, we think it does represent a good diversifier for UK investors. Again, given our focus at Middlefield, we are squarely focused on equity income, which basically means that we're focused on companies that can pay high and growing levels of dividends, and that's what we're doing in Middlefield Canadian. We pay out a dividend of 5.2p per year, which currently represents a yield of about 5%. We increased that distribution early this year. We are running a covered dividend so far in 2023, and the board's view would be to continue to increase the dividend over time, assuming that the fund is able to sustain a higher level of dividend. So clearly that's the case. We're high conviction managers, so we buy companies that we know well. We meet these management teams on a regular basis, so as a result, there's relatively low turnover, and we're trading at a discount to NAV currently of about 11 or 12%. So we think that represents excellent value. On the right-hand side of this particular chart, you can see our performance, and in particular, long-term performance has been very competitive in excess of our benchmark, and it's this shorter run performance really on the back of higher interest rates, which has caused a headwind against equities generally, and in particular, more interest-sensitive equities like real estate or like our utilities or even financials. So as a result, there's been some more challenging performance in the shorter term, and we think that is really on the verge of starting to turn around now. And the reason we think that is that what you've seen here is this rapid rise in interest rates, really beginning from the spring of 2022 up until recently. The Bank of Canada met last week, and it chose to not increase rates. So the signals are that as long as inflation remains in check, and we think it will, that they're basically going to be on hold. I think you're likely going to see the same decision out of the FOMC next week when they meet, that they'll basically remain on hold as well. The way I like to look at it is that we're at least in the 8th inning of this interest rate hiking cycle, and we may very well be at the end. And any way you look at it, it's basically over. And I think that's now going to provide investors with more clarity on interest rate hikes and that they're basically over. So I think that causes them to feel better about some of the sectors that we're invested in. And that's why I think you're going to start to see some performance turn around.
Cool.
Next slide.
Yep.
So here's how the portfolio is positioned. And again, it's really looking to fully exploit some of these macro and more high-level issues I've been talking about with respect to increases in population, with respect to the interest rate cycle being over, with respect to looking for security and energy. So we have energy and pipeline exposure in aggregate at about 37%, and that's up from the low 30s early this year. As you've seen, we now have Brent prices well through $90 a barrel. WTI, which is basically the oil price that we receive here in North America, is now at $90 a barrel. Natural gas prices are now approaching $3 an M, and we're completing LNG export facilities, which would see us receive closer to $10 or $12 an M in natural gas prices.
Right.
So there's some upside coming from that over time. So we're very constructive on the outlook for energy right now. And again, it goes back to this issue of the world basically changing on February 24th of last year when Russia went into Ukraine, and people now better appreciating the need for hydrocarbons as we bridge ourselves to a more renewable future in energy over the next few decades.
Yeah.
Real estate would be one of our major outliers when you look at the benchmark weighting. Matthew, it's basically closer to about 5 or 6%, and we're at about 23%. And we've just heard you describe some of the challenges in the real estate market in the UK. And similarly in Canada, we've got real estate trading at significant discounts to NAV. But in my 25 plus years in managing publicly listed REIT portfolios, I've rarely been as excited as I am today about the fundamentals in the sector. I've basically met with virtually all of our REIT management teams in the past 2 weeks. And I can say that outside of the office property sector, the outlook for Canadian real estate in particular is very, very attractive, as good as I've seen in the last decade. And as I mentioned as well, financials, which represent in our benchmark about 32% of the market, we're closer at 21%. The reason why we're underweight there is because we think there's still going to be some lagged effect in terms of where capital markets activity is going to be. The wealth management business, we think it's going to take some time here to turn around. So we still have a healthy weighting. We still have very high conviction in the quality of our Canadian banking system. But as a result, we're underweight here, and you may see that nudge higher as we go into 2024.
Okay, we do actually have a couple of questions that may be worth addressing here. Because I think people are obviously aware of the sort of sector allocation you've got here. One of them just says real estate companies comprise about a quarter of MCT's holdings. You see, obviously, they're a significant overweight. Could you just talk about your rationale around this? Obviously, we've covered the valuation argument, and we've also, obviously, you've been speaking to them and you're sort of feeling very confident on their outlook. But I think this is is this sort of long-term structural overweight, if I remember rightly? Perhaps we could just talk a bit more to that.
Yeah, happy to. I think we might have it on the next slide here as well.
All right,
Talk
okay, let's
about
quickly look at
real
that then.
estate. Here we go. So when you look at the sector as a whole, it's trading at about a 25% discount to its NAV. So the real question there is the NAV a true NAV? And if you assume that it is, and I'll get into the detail there in a second, then why is it trading at such a discount and what's the outlook? So firstly, we've looked at these companies very carefully. We own about 8 or 10 of them in the portfolio. And I've known these companies and these management teams for now over 2 decades, for the most part. And we think they've done a very good job in terms of increasing the capitalization rate, which is used to determine the value of their assets. And they've been quite conservative in terms of how they manage the valuation of their assets. So in addition to that, there have been some third-party transactions in the market that, again, are validating the value of their assets. So we do think the NAVs are actually properly reflecting the current environment and including the current interest rate environment. First point. Second point is, why are they trading at such deep discounts? Now, this 26% discount you see on the screen here is actually skewed to the downside or skewed higher by virtue of the office sector. We've got a couple of office REITs in Canada that are trading at 40 and 50% discounts to NAV. And it's important to highlight, we don't own any office REITs in the Canadian portfolio. Yes, they're very cheap, but we still think there are some real headwinds and issues, including negative sentiment that needs to be overcome in that sector. So our portfolio, which comprises industrial property, which comprises apartment REITs, and also retail brick and mortar REITs, this is where we really see the fundamentals extremely strong. So on industrial, Matt, again, the Greater Toronto area is the hottest industrial market in North America. It's the second largest in North America, second only to Chicago. We've got vacancy in this market at less than 1.5%. We've got rental rates and releasing spreads in particular in 2023 that are 20 to 30% higher than the leases that were in place. So the increases in cash flow continue to be very good. On the apartment REITs, again, when you think about the types of population increases we're seeing in this country, because we've got a shortage of labor and we've got a points-based immigration system that's trying to bring in new Canadians who can address some of these shortages in labor by ranking them based on their skill set. We think that really drives demand for housing. And currently, we have the lowest level of housing per capita in the G7. So average rent for apartment REITs today is about $1,800 per month. The market rent is closer to about $2,700 or $2,800 per month. So when a tenant vacates an apartment and a new tenant comes in, that's when, in a province like Ontario, they can actually increase the rent to market rate. So that represents about a 30% increase, 40% increase in some cases for those apartment suites. In a province like Alberta, where you've got some of our apartment REITs operating, there is no requirement to wait for a tenant to leave before you increase the rent. You can mark it up to market rent each and every year. So we think that outlook remains attractive. And then we have a shortage of supply in apartments in Canada. And just yesterday, our federal government announced that they were waiving what we call the HST, which is an excise tax, which is total of 5% federally and 8% provincially on any new purpose-built rental construction. So that creating another incentive to create more supply, and some of our REITs are very active in that, which we think will generate additional cash flow for them as well. So we think that's positive. And then the last area would be the brick and mortar retail. And again, these are not shopping malls, which have been the most challenged part of the real estate market. They are Walmart or grocery anchored open air centers. We haven't seen much new construction, so the supply is constrained. And as I talk to each one of the CEOs of our apartment REITs, and there's an interview with one that's on our website with one of our largest holdings, which is Choice REIT. I had a meeting with them earlier in the summer. They are the landlord to Loblaws, which is our largest grocer in Canada. They're saying virtually all of their major tenants are looking for new space.
Right. Okay.
And hence rents are going higher. So for those fundamental reasons, this is a very attractive time to be invested in the sector. And when you look at the macroeconomic picture with rates now basically plateauing and likely going lower later in 2024, we think we finally are going to see a point where investors can feel more comfortable about coming back into this sector.
Okay. Just sort of a couple of questions on that. I mean, with this sort of retail-oriented portfolio, I mean, what do you think the sort of threat to that is from increasing online retail penetration?
Great question. So, we've seen the increase in e-commerce or online retail penetration over the last 15 years. In Canada, while like most economies, we saw it spike during the pandemic and now it's come back down, effectively in line with that trend that existed prior to COVID. And we're right now in that kind of 12 to 15% total online shopping in Canada. That's nudging higher. But again, what's really happening, again, we're focused on these necessity-based grocery anchored retail. The Walmarts of the world or the Loblaws of the world, they're basically using those physical locations not only as a place where people can come and shop, but they're also using those as distribution centers.
Yeah.
So a portion of those stores is actually being used to facilitate that online shopping for consumers who are choosing to buy from their computer as opposed to buying in person in the store. Yeah. So at the end of the day, Matt, we think even with this continual growth in online shopping, there is demand for these centers. And maybe the best example of that is that earlier this year, Bed Bath & Beyond, which is a U.S. chain, it went bankrupt. There were some 65 locations, primarily within our Canadian REIT portfolios in Canada. Each and every one of those locations were actually released at a higher rate within about 6 or 7 weeks of that bankruptcy notice in the spring of this year.
Okay, that's impressive. I think I have one other question on the retail exposure here. It just said, would you consider a shift away from such a high exposure to real estate if we see more evidence of a structural shift in how these assets are valued? I mean, I presume that means sort of they became more expensive, because obviously this has been a long-term overweight, hasn't it?
It has. It's been a high conviction for us really since kind of late 2020, early 2021. And the short answer is yes. At the end of the day, we are looking at valuations. We're effectively a GARP type of investor, growth at a reasonable price. And if we don't think these prices are no longer reasonable, you will see us rotate out of this sector into other areas that we think are more attractive. But right now, as I've been discussing, we just think the value proposition in these REITs remains quite attractive. But in 6 or 9 months' time, Matt, it could very well be the case. Yeah.
Okay, super. Got another sort of couple of questions on the portfolio. Is it worth sort of addressing those now?
Sure.
One of those is sort of what you see as the biggest risks to the portfolio. I mean, I don't know if it's worth skipping back to the previous slide. Would that be useful or?
Sure, happy to. So, I think the biggest risks will certainly the biggest risk is if in fact we end up with a severe economic recession. And, at the end of the day, when you think about our exposure to energy, our exposure to real estate, and even the financials, I think each one of those areas would be significantly impacted. Our view is that while the economy is slowing, we don't see a hard landing in the cards. And, we think you'll likely start to see a reduction in interest rates if in fact the economic data is showing that things are actually contracting more than central bankers are expecting. Yeah. So, we think there's probably going to be some reaction to that to soften the blow, but clearly that's the biggest risk. And on the other side of it, if inflation starts rearing its head again, And then you see central bankers start to increase interest rates beyond the level where they are now. Again, as I mentioned, we may see another quarter point bump. I think the likelihood of that is still low, but even if that does happen, we think it's effectively over. Now, let's assume that inflation really does become more endemic and it starts increasing again, then I think that's another risk to the portfolio. Yeah. Putting those aside, Matthew, I think at the end of the day, we think the portfolio is in very good shape.
Excellent. Okay. There's another portfolio related question. I did see the answer to this on one of the slides. It's what is the turnover in the portfolio and what's the sort of average holding period? Now, if I remember rightly, is it around 20%? I think I saw that on one of the slides, which sort of implies a typical holding period about 5 years. Is that right?
That's correct. Some of these companies I've effectively had in the portfolio almost since, we launched the fund in 2006. But,
yeah.
At the end of the day, the best way to describe it is that we are a high conviction, not a high concentration, but a high conviction portfolio manager. We typically have 30 to 40 companies in the fund at any one time. So as a result, average weighting somewhere in that 2.5% to 3.5% per issuer.
Yeah.
And then we also have real discipline in terms of how we manage our funds, including Canadian Income. No one company would be less than 1% of the portfolio. And at the other end, in an effort to control the risk in the fund, we typically cap weightings at about 5%.
Yeah.
So there are some exceptions where they kind of migrate above that, but generally speaking, the high end would be about 5%.
Yeah.
And we need to see a real impairment to our view on a sector or our view on a company if we were to sell it out entirely.
Right. Okay. That makes a lot of sense. But the sort of 5% caps, presumably that is just for sort of good portfolio management purposes. Is that right?
That's correct. Now, I've been doing this long enough where even some of my highest quality holdings can get a bolt out of the blue. And if they represent, much more than 5%, it becomes almost impossible in the short term to recover from something like that if there's a real pullback in the stock. So, we've decided, based on our experience over decades here, that 5% is a reasonable number as a cap.
Yeah. Yeah. Okay. Obviously that's sort of quite a few stocks, or not an insurmountable amount. Somebody's asked, how big is the team at Middlefield that's managing MCT?
Sure. So I manage it. So I've been managing it since inception. It's the only diversified fund I continue to manage. But I also continue to actively manage our dedicated REIT funds in Canada. And I've been managing the portfolio since 2006. My co-manager is Rob Lozon, who's been with the firm since 2002. He also manages our flagship Canadian fund, which has a very similar portfolio to this one. So he and I work very closely together. We're supported by a team of 4 analysts and a dedicated trader, all of whom are a little younger than I am. So there's good succession in place. So generally speaking, we've got a very well-rounded and deep team overseeing the fund. Yeah.
Yeah. So one question here. It says, obviously, the fund has the ability to invest up to 20% outside of Canada, but at present there is no exposure in the portfolio. Is there any particular reason for this? Now, my guess would be that you've probably got plenty of opportunities in Canada, but is that something you'd like to elaborate on?
Sure. So, in fact, we can go up to 40% outside of Canada, and that's really dedicated for the U.S. And there have been times over the last 7 or 8 years where I was as much as 35% weighted to the U.S. So the focus again is on companies that pay an income. So, for example, in the U.S. market, my exposure has historically been in areas like high dividend paying technology companies. So Broadcom for a long time was a position in the portfolio. Microsoft was. Areas like healthcare, companies like Pfizer were also longtime positions in the fund. So we've generally gone outside of Canada and into the U.S. to get exposure to areas we can't easily get in the Canadian market.
Right.
So we really don't have a publicly listed tech sector in Canada. We really don't have a publicly listed healthcare sector in Canada. So today, we don't have any exposure to those. We're basically 100% Canadian. Having said that, a number of our Canadian companies have significant business in the US. So for example, our banks, Matthew, have about a third of their business in the US market. You know, TD Bank is, I think, now the sixth largest bank by branches in the US market. The Bank of Montreal, which is one of our largest holdings, just completed the acquisition of Bank of the West in the US for $20 billion. So you're already getting that exposure. Some of our REITs, like Granite, which is our largest industrial holding in this portfolio, has about 50% of its business in the US. So you're getting that. But bottom line is, we're just seeing better value, as we showed early on in the presentation, in these Canadian domiciled companies where we see that opportunity. Fast forward 6 or 12 months, you know, you might see a greater US weighting than you would see today.
Okay. Just got a question here on the renewables exposure, which we've got on here. It says, what is the actual sort of portfolio allocation for renewables, as this will no doubt have to increase if net zero continues to dominate politics? Also, if the net zero focus continues, are there sufficient worthwhile assets in Canada to invest in and produce decent and reliable returns?
Great question. So renewables are within our utilities portfolio, and this has been the part of the market that has really lagged in the past 12 months. So not surprisingly, utilities being very interest rate sensitive with the rise in rates. You know, you've had some underperformance in utilities. With respect to renewables, we do have some key renewables companies in Canada. Our most significant renewables weighting in the portfolio is a company by the name of Brookfield Renewables. I think most people would recognize Brookfield. It's a Canadian domiciled business, you know, major infrastructure player, big renewables player. The stock really hasn't performed very well over the last 4 to 6 weeks. But generally speaking, it is a core holding in the fund. And there are a few others that we can get exposure to. You know, another company that we've had in the portfolio for a long time. It's not in today, but you know, we just met with management in the past earlier this week, actually, at a conference here in Toronto. It's a company by the name of Northland Power. Again, been a long-term holding in the fund. Again, not in currently, but another one we can add. Companies like Boralex or Energex, again, in the hydro area. Recognizing that on renewables, we've got significant hydro assets in Canada that we can include in the portfolio if we thought that was the best use of our capital.
Okay. Presumably, obviously, you've got the renewables and you've got utilities, but I'm guessing the underlying utilities, there's a trend there to moving towards more renewable generation as well. So
absolutely. So, you know, basically, they're all moving in that direction where they're increasing their renewables exposure. And I would really go on to say, Matthew, that even in our energy area, non-renewables, but our energy producers, you know, or pipeline are moving more and more into that direction. Like BP and Shell in Canada, our largest investors into renewables and cleaner technologies are our traditional hydrocarbon businesses. So they're making significant investments there. So you're really getting that exposure to cleaner tech, not only within the utilities, but also in our energy and pipeline.
I mean, if we were sort of taking a slightly longer term view, you've obviously got about 15% at the moment in utilities, renewables combined. I mean, where do you think that might get to? I don't know, in 5-10 years. Could you see that going up?
I would see it going up, and it could in fact be even sooner than that, because you know, we've got some high quality renewables businesses that, again, largely trade on macroeconomic policy and interest rates in particular. And if in fact you start to see interest rates come down, maybe as early as next year at this time, then you could actually see a larger weighting in the utilities portion of this portfolio.
Okay. Just conscious of time, just a few more questions to get through here. Somebody says, as a sort of sterling denominated fund, how do you manage foreign exchange risk?
Sure. So the board looks at this issue at each one of its meetings. And so currently, we do not hedge the currency. So effectively, we're allowing investors to get exposure to CAD and or US if we've got US dollar exposure. And, you know, when you look at the trading range of CAD to GBP historically, we're basically right in line with kind of the long-term average. And when I look at CAD versus the UK, you know, I'm probably more constructive on CAD, just given kind of where we are in this geopolitical landscape, our abundance of resources, you know, where we see energy prices going forward. So we think not only are we trying to provide investors this unhedged exposure to CAD, we also think that there's some good reasons to own CAD right now.
Okay, super. Probably one last question. I know you were saying earlier that the sort of dividend is fully covered. Somebody's asked, what is the dividend coverage and how much is the revenue reserves to support the dividend? Is that something you can address for us?
Well, the dividend coverage is currently, it depends on some of the assumptions you're making, but based on our assumptions of, the current FX rate, because FX does affect the dividend coverage, and assuming some of the dividend growth that we've seen in the portfolio for the year, we're in that kind of 105, 110% dividend coverage range. There currently aren't any revenue reserves, but last year we had dividend coverage in that kind of 116 to 120%. So just today, Matthew, we reported the half-yearly results. So for the period ended June 30, we generated earnings of about 2.84p, and we paid out about 2.6p. So there was some, excess earnings there to cover the dividend.
Super. Okay, I think that's probably about all we've got time for today. So thanks very much, Dean. Hope we can get you back in a year or so to give us an update on how all of it's going. If I just scan forward here, once again, there's disclaimer. So if you've got time, please have a look at that or to come back and look at it later. Just to give you an update on what we've got coming up. So basically, we're now fully booked all the way through to the end of October. And I do know, actually, we've got a couple of things in the diary already for sort of after that. But so next week, we've got, Richard will be here doing this, Andrew Jones from London Metric Property. 29th of September, we've got Carlos Hardenberg from Mobius Investment Trust. 6th of October, we've got Alan Gould to talk about Aberdeen private equity opportunities, and obviously Andrew McHattie to give his usual monthly update. 13th of October, James Duphow, sorry, I can't remember how that's pronounced, but talk about Edinburgh. James Dupper, that's it. And then on 20th of October, Tom Williams from Down Renewables and Infrastructure, and finally Richard Sem on the 27th to talk about Pantheon Infrastructure. But thanks, everybody, and hopefully see you back here next week. Have a great weekend.